How resilient is the U.S. economy as we look towards 2026? With household debt near multi-year lows and equity markets at record highs, what does this mean for investors? Stay here as we explore the Fed's next moves, the story behind household debt, and key takeaways for making sense of today's financial landscape. All coming up right now on UBS Trending. Hello, everyone, and thank you for joining me. This is UBS Trending, and I'm Anthony Pastore. Good to have you join us today. Bill Sterling, global strategist with GW&K, is back in the studio with me. Bill, always a pleasure to have you. Thanks for coming by.
Great to be here. Thank you.
I was reading through your most recent Global Perspectives piece that you released this month, and it's talking about the resilience of the U.S. economy, which we talk a lot about the markets and the economy and what the Fed's going to do and where rates are, but you're taking it from a kind of a different perspective of looking at household debt and mortgage debt. Let me ask you about the resilience of the U.S. economy today. What got us here, and what are you looking at? When you look through your research, what are you finding?
Sure. Well, we've had two big shocks in recent years. The interest rates going from 0 to 5.5% in 2022 was a big shock. It inverted the yield curve. People thought a recession was coming. No recession. Mm-hmm. Then we had the tariff shock this year. We've ridden through that pretty well. The tariff rate has come down from the Liberation Day highs, but still the consumers kept on going. Economy's chugging along. And when I look into the causes for that resilience, one thing that's pretty striking is the good shape that balance sheets are in. It's not the debt's at an all-time low, but debt relative to GDP. Whether you look at household debt versus GDP or consumer debt versus GDP, mortgage debt versus GDP, all those measures are in really good shape. And also cash holdings by households are in really good shape, and by businesses for that matter as well. So that, I think, gives the economy quite a bit of resilience to deal with shocks, because it means households and businesses have the wherewithal to kind of ride through any of these shocks that have come along.
Yeah. You wrote about how household debt, specifically mortgage debt, which most of us who have mortgages, as we all know, the percentages of those of us who are under 6% on our mortgage rate is pretty high. So there are very few out there who might be even thinking about refinancing, because some people are locked in at 3-4%.
Yeah.
But the consumer debt is also near multi-year lows. And in the report, you talk about how the pandemic kind of effectively changed things for where we see debt today. What's the story, and really what's the impact of that?
Yeah, I think part of the story is in the pandemic we had massive amounts of government stimulus, which basically funneled money to households and businesses and let their balance sheets improve, even as the federal balance sheet worsened. So we kind of rearranged the deck chairs in terms of where the debt was held in the economy. And these leverage ratios, like the mortgage debt in particular, that had hit 73% of GDP at around the time of the housing bubble in the mid-2000s, the first decade of the 2000s. And that's back down to 44% of GDP. So that's back down to where it was decades ago. Mm-hmm. So these are not multi-year lows in these debt ratios. They're multi-decade lows. And for example, housing, the equity, owner's equity in housing is back to where it was in the late 1950s.
Wow.
So relative to housing prices, people's skin in the game, the amount of equity they have in their homes is huge relative to recent, patterns.
Yeah, and it's incredible to see house price. There's a house price index, of course, that we follow, and you can see, certainly geographically in certain areas of the country, that house prices are going up again, minus areas like Florida, which were kind of oversaturated, maybe Texas, but California, New York, other areas, they're seeing household prices go up again. So it's an interesting dichotomy between where there was some oversaturation just in the post-pandemic years and where maybe some people were fleeing during those years and maybe coming back, or house prices are coming up. And even looking at the distribution of household net worth, we had a chart that you gave us that talked about generationally the household net worth between boomers and Gen Xers and millennials and the silent generation. That's a fascinating look and picture as well about what's happening in this country.
Yeah, I think that's another potential source of resilience, because the baby boomers and basically their parents, the so-called silent generation, collectively control about 2/3 of the wealth in this economy, even though they're less than a quarter of the population. So that distribution is massively suggesting or pointing to an inheritance boom that will go on for many, many years, because they collectively control $105 trillion out of the roughly $170 trillion of household wealth.
Right.
So if 1% of that per year trickles down to younger generations in the form of gifts, like help with tuition, help with down payments on houses and so on, or outright inheritances. That's $1 trillion flow every year from the older generation to the younger generation. 3% of GDP, not a trivial amount.
Right, and we know that particularly Generation X is underfunded when it comes to their own retirements because, and we were talking about this earlier, they are the first generation to not really have pensions by and large, where a lot of the baby boomers and older did have pensions, which allowed them to live a certain lifestyle and then save and then be able to pass down these inheritances. So it's a really interesting picture and how different it is between the generations. Thank you for sending us that chart. I also want to take your kind of mind now into where the Fed might be going. As we sit here today, the data that we're receiving about jobs is a little bit mixed. We may not get the unemployment data because of the government shutdown. That's according to the Bureau of Labor Statistics. But there is data coming out about jobs, and we're still looking at inflation rates. What's your expectation for the actions of the Fed? If we assume that they are going to still cut in December, which is still the base case here in CIO, what do you expect to see from the Fed as we move into 2026?
I think it's interesting because, the labor data we got today was stale. It had a little bit for everyone because jobs were greater than expected, but the unemployment rate rose to 4.4%, which could justify the Fed cutting in December. But I think the way the market's looking at it is regardless of whether it's December or January, the market's still looking by the end of next year to see 3+ quarter-point rate cuts, maybe 4. And I think that's still a reasonable way to look at things because with the data vacuum that we had due to the shutdown, we paid a lot of attention to things like the ADP reports that did show that the data we finally get for what's the November data we're not going to get until December 16th is probably going to show a pretty weak labor market in the October-December framework when we get that data. And the Fed's looking at that. I just saw a statistic from the University of Michigan that says you have a record number of households in the U.S. by their survey expecting unemployment to go up over the next year, a record since 1980. So through all the shocks we've had over that period, that's the amount of kind of concern that households have about employment prospects over the next year. And I think the Fed's got to take that into consideration.
Yeah, for sure. And it seems like there's some commentary coming out from some Fed governors, saying that they do expect that a rate cut in December is still a good idea because it might provide a lot of shock to the markets if they paused at that point and then waited again until 2026. And maybe there's not much of, the reasoning behind them staying paused, as you said, because we are seeing signs that jobs may be on the decline. So given all that then, Bill, if you look at what the Fed is expected to do and the data you're seeing for jobs, where we see inflation headed, which is somewhere around 3% right now, what's the takeaway for investors as they try to navigate all of this, including what we talked about earlier, which is looking at household debt and income? Where should investors be thinking as they move into 2026?
Well, I think these factors for resilience, the good household and business balance sheets, the demographic, ongoing sort of transfer of wealth from the older generation to the younger generation, those are all reasons, I think, to help expect no recession next year, especially when you combine it with the factors we know seem likely, which is lower rates likely to be coming from the Fed. The big, beautiful bill stimulus looks like it will add almost 1% of GDP by tax benefits, including big tax refunds that start occurring early next year. And you've got low oil prices in the mix, and of course a big AI boom that's got legs. So all of that suggests to us that we could see better than expected GDP, something like 2.5% plus next year, and double-digit earnings again next year, suggesting even though valuations are high and that makes us all nervous, there's still a pretty positive outlook for the stock market.
Yeah, and as you talk about AI, we're getting earnings from a lot of these AI-related companies that are beating expectations. So the story is real. The fundamentals are there. So it seems like it is going to be a continuing headline as we go into 2026.
Absolutely.
Yeah. Bill, thank you very much. Always a pleasure to have you here. Hope you have a wonderful Thanksgiving and a holiday season, and we'll see you in 2026.
Thank you, Anthony.
Thank you, Bill. Good to see you. Bill Sterling again, global strategist from GW&K. And thank you all for joining us. If you'd like more information on everything coming out of our great partners like GW&K, as well as our own Chief Investment Office, please visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, you can also check out our dedicated channel for UBS Studios at our Instagram page at UBS Trending. Lots of content there for you. And as always, if you'd like to continue this conversation, please make sure you are connecting with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending, everybody. We will see you soon.